All right, welcome to this explainer. Today, we're literally pulling back the curtain on an actual institutional investor pitch for the world's largest bank, ICBC. We're going to break down the exact arguments, the data, and the strategies that analysts are using right now to pitch this colossal institution. Let's find out what makes this behemoth tick. So, just to wrap our heads around the sheer scale we're dealing with right out of the gate, consider this number, 86.9 billion yuan. That is their net profit for just the first quarter of 2026 alone. This 3.3% year-on-year increase actually marks their best growth since late 2022. And honestly, that's a massive feat when you consider global banks everywhere are battling some pretty severe economic headwinds. We're going to logically deconstruct this pitch across 4 distinct pillars today. First, a financial turnaround. Second, value and high yield. Third, digital currency and growth. And finally, key risk factors. Let's dive right into Section 1, a financial turnaround, breaking down the numbers. Okay, before we actually look at the turnaround data itself, we really need to understand a core banking metric called net interest margin, or NIM. Basically, it's the crucial difference between the interest income a bank earns from its lending and the interest it pays out to its depositors. You can think of it as the ultimate engine of bank profitability. If NIM shrinks, well, the bank is getting squeezed. So what's really fascinating here is that after a long, drawn-out period of decline across the whole banking sector, ICBC's NIM has actually stabilized and improved. In Q1 2026, it ticked up to 1.29%. Now, a 2 basis point increase might sound incredibly tiny, right? But for a bank of this massive scale, it represents a huge turning point. It's driven by lower funding costs and just really, really disciplined pricing. And this whole turnaround is essentially built on 3 solid pillars. So it's not just those recovering margins. We're also seeing robust revenue diversification. Net interest income is up 7.5%, and fees are up 5.2%. Combine that with rock-solid asset quality, non-performing loans are sitting steady at 1.31%, and a massive 214.4% provision buffer, and you've got a highly fortified balance sheet ready for any unexpected shocks. Moving right along to Section 2, value and high yield, the income opportunity. Now, here is the absolute crux of the pitch. It's this massive valuation disconnect. Think about it. You have this globally systemic giant with a pristine balance sheet, yet its H shares are currently trading at a steep discount of just 0.54 times its estimated 2026 book value. The argument analysts are making is that you basically have a rare opportunity to buy into the world's largest bank for roughly half of its underlying asset value. That's huge. And, this underlying value definitely isn't a well-kept secret. Major analyst firms are impartially issuing buy ratings based on a really strong earnings outlook. BOCI, for example, set a target price of 9.22 Hong Kong dollars, explicitly calling the stock undervalued. And they aren't alone here. Heavyweights like Jefferies and DBS Vickers are echoing the exact same sentiment. But the real highlight, and honestly what this pitch heavily emphasizes, is the income opportunity. The forecasted FY 2026 dividend yield for IBC sits at a highly attractive 5% to 6.2%. In a world where government bond yields are continuously compressing, this easily outpaces the alternatives. It's essentially paying you exceptionally well while you wait for the broader market to finally catch up. All right, on to Section 3, digital currency and growth, positioning for the future. So looking past the traditional legacy balance sheet, ICBC is aggressively expanding, and they're overcoming major hurdles at a really rapid pace. After swiftly containing a ransomware attack on their U.S. arm back in November 2023, they just bounced right back to pioneer some major innovations. By March 2026, they became the first Chinese institution to execute foreign currency tri-party repos. And that all culminated in a historic milestone in July, the first ever cross-border digital yuan payment between China and Singapore. To further cement this dominance, they just announced a dedicated special quota of 1 trillion yuan. And this is solely to promote international trade settlement. This massive allocation is a very clear signal of their absolute intent to become the go-to institution for global investors trying to access China. But, of course, to keep this explainer fully objective, we have to look at the other side of the coin. Section 4, key risk factors, weighing the downside. Analysts generally break the downside into 3 distinct threats. First up, macroeconomic pressures. Basically, if China's economic growth slows down more than expected, the bank might be forced to support the real economy, which could mean margin compression or elevated non-performing loans. Second, regulatory shifts, like the easing of shareholder restrictions we saw in March 2026, which just always requires close monitoring. And third, the ever-present threat of global cyber attacks, like that 2023 incident, which carry the risk of severe institutional disruption. However, the analyst thesis strongly argues that these risks are heavily mitigated by structural defenses. They point right back to those massive capital buffers, that robust 214.4% provision coverage we discussed earlier, and ultimately an overarching government commitment to broad financial stability. All of that acts as a really powerful safety net. So, after unpacking the turnaround data, the digital innovations, and objectively weighing the risks, it leaves us with one critical question. Is the broader market entirely missing the true underlying value and future potential of the world's biggest bank? Because when you weigh their fundamental strength against a nearly 50% valuation discount, it is a fascinating disconnect. So, what do you think?